Tabb, founder and CEO of the Tabb Group, and we are a financial markets research and advisory firm really focused on institutional capital markets. Training becomes very important when working in this environment. If you look at traditional human traders, they don't understand how computers work. If you look at computer engineers, they don't understand how markets work. And so we need you're starting to see a new breed of technology engineers come into the trading markets. And then the problem with that is that they don't understand how to talk to traditional, like institutional investors. So there are large gaps in the communication and protocol and understanding and communications within the marketplace that need to grow up. In fact, some of the problems I think with HFT and why it's been so villainized is that many of the high frequency players, they don't really have customers. They don't really have what we think of as traditional brokerage business. They're just trading kind of for their own money, and so they don't understand. They don't understand their impact on the market. They don't understand how to explain their impact on the market, and to a certain extent they're very secretive, and so that has created tremendous ill will and I think confusion around what their purpose is in the market, and that whole idea of education and understanding and where they fit and what they're doing and is it nefarious or is it not nefarious actually is a big issue that needs to come to grips. And actually, because of this, the regulators are starting to look at things to kind of slow the markets down and stop some of this stuff. In some cases, yeah, I understand. In other cases, I'm not sure it's the right thing to do. I won't say that the exchanges don't have the right people. What I will say is that what we've seen over time is that that there are entities and proprietary trading shops that have a much that can afford to pay these technology guys a lot more money to work for them, and so. Good technologists, tend to go where they're compensated the best. So it becomes hard. It becomes harder for exchanges and to a certain extent, increasingly banks to maintain really robust technologists because some of the less regulated entities have a greater ability to fund their positions. I think when you look at volumes, especially in the equities markets, what we saw was a tremendous run-up in volume in terms of 2008, 2009, 2010, and in 2010, was kind of the top of the market, and actually we're seeing volumes almost 50% of what they were trading volumes, what the share volumes of what they were back then. Now that said, in nominal value, in value traded, actually it's not that different because there's other issues around stock splits and stuff like that. But I think what we're coming into is kind of a new normal where that we're not going to see the run up in trading volumes that we saw in 2008 and 2009 because I think a lot of that had to do with people reacting to the credit crisis as well as reacting to new technology infrastructure. So they weren't that familiar with a lot of the algorithmic trading infrastructure, as well as they wanted to really restructure their portfolios because of what was happening with the global financial crisis. And so so there was a lot of volume in 2008, 2009, 2010. Their portfolios were kind of restructured, and then the volume has kind of drifted down. We've seen it kind of plateau. We don't see the kind of drops that we saw over the last couple of years. We think it'll consolidate kind of roughly around this volume and then start slowly building back up. But I'm not sure we'll get back to the, at least in the U.S., the $13 billion share days that we saw, in 2010. At least not for a long time. So when you look at major markets and you look at like the Latin America markets or the Asian markets, you're looking at different types of high frequency trading. So I'm not sure that we'll ever see the kind of high frequency trading in Mexico or Brazil or Peru or Chile that we see in the U.S. They don't have the kind of fragmented, exchange infrastructure, many different markets. They don't have the kind of trading volume. Now that said, it would, having better and more efficient technology to match buyers and sellers and speeding up that process is good because, to a certain extent, it makes it less expensive to trade. It makes it more efficient. It just, makes it more easy to interact with the market. But you probably won't be seeing, the nanosecond infrastructures that they're driving themselves crazy with in the U.S. and Europe. And so to have a more efficient risk management infrastructure, to have a more efficient matching platform, to have a more efficient, market data analysis platform, I think all are good. And I think what that does is it provides a much fairer, much better, a much more stable price, within the exchange. So I wouldn't worry about that too much. When you start looking at going overseas, there's a lot, or not even overseas, but cross-border, there are a lot more issues in terms of how you manage that from a domestic standpoint. First of all, do people know what they're actually buying? How do you manage the currencies? How do you manage the risk? Are the regulators okay with me as an individual buying a Chilean stock, through, Bolsa Mexicana BMV? So it's easy to get the technology. Okay, so I call my broker. They put the order into Bolsa Mexicana. Bolsa Mexicana has a linkage with Chile, and the shares are executed in Chile. The problem is that you've got two different currencies. You've got clearing facilities in two different countries. What happens if my broker goes bankrupt? What happens? How does all that risk play out? And that infrastructure can get pretty complicated. In the States, actually, it's actually very backward. It's very difficult. The SEC does not like U.S. citizens buying foreign companies. So there's a very sophisticated depository receipt process within the States. So the Seminex, if I want to trade Seminex, I buy on the New York Stock Exchange the Seminex shares directly, or I would buy a depository receipt, but it would be in U.S. dollars and it would be held in the U.S. It would be very difficult for me to buy what they call the ordinary shares, the shares on the Mexican Stock Exchange. Because of these issues around where's my money, where are the stock shares located, what if somebody goes bankrupt, how do I get that back, it becomes very complicated.